Hello, welcome to the Market Carver. I'm Adam Harder, Chief Investment Officer of Financial Enhancement Group. Once again, so thankful you took your time to click this open and watch this video. We're in the midst of our thirdly season. Hopefully we have the chance to catch you physically at one of our dinners or lunches or digital if we get you that way. That'd be great too. But in any event, want to cover a few of the topics this week that we covered in this week's investment allocation meeting. Kind of significant development or some changes. First, we're going to talk about Capex spending and it being on the rise for the first time in quite a while, improving breadth in the market, seasonality, and then the contributions specifically to inflation, everybody's favorite topic this year. But first, we're going to talk about Capex or capital expenditures. These are the major investments by corporations. Specifically here, we're measuring capital goods orders that are a non-defense. So if we were to look at this chart over the past couple of decades, it would look quite a bit different because defense spending has actually been pretty high. So we want to adjust only looking for non-defense spending because from that angle, we can get a true glimpse into the large ticket item orders that can improve productivity in corporate America. And that has been something that has been lagging for a couple of decades. A couple of reasons why. The first, in the late 90s, there was a lot of spending. A lot of it went into the wrong areas. This was the dot-com boom, so a lot of it was chasing that theme. Then in the mid-2000s, we had a little bit overinvestment in housing, or a lot of overinvestment in housing, one of the two. And then the fallout from the great financial crisis made it very difficult for a lot of companies to access capital. So all that combined, we haven't seen corporate America invest. That's been a recurring theme, and that's been something that we've hoped for each and every year, going back over at least the past 10 years, hoping that that would be the one thing we would finally see, significant investment, and we're finally beginning to see it. Now, it doesn't maybe necessarily seem right. When you look, it seems like there's so much negativity around us, not only this year, but last year. But corporate America is spending that money. One reason why is labor is in short supply. So what do you do when labor's not abundant? You increase your investment into plant property and equipment, whether that's software, computers, machinery, whatever it may be, to try to get more output per worker. This just holds so many keys for our country, not only, again, to be a good engine of economic growth in terms of capital expenditures, not only to improve proper future profitability, but also to help alleviate inflationary pressures. That's one of the greatest tools that we have, is to increase the output per worker hour. And this spending is one way to do it. This isn't a magic pill. It's not a silver bullet. It's not something that we have seen sustained yet. And furthermore, it's not been something that's been proven to be in the right areas. However, it is a great first step. Moving now to the technical side of the market and improving breadth. Over the past 6 months, one of the themes that have dominated this has been a pretty strong S&P 500, at least one that's maintained its range. But we've seen smaller companies, and a lot of them underneath those few that dominate the S&P 500, not do very well. In fact, we shared not too long ago, your average small cap stock was nowhere near its high from February. So even though the S&P 500 was doing well, not a whole lot of other things are. That's starting to change. So that is a very good thing, and we'll hope to see that continue, and it's actually right on cue because we are moving into a much more positive piece of the seasonality. So seasonality is a clock that generally means stocks perform well from about late October in through the May period. Now, it doesn't always work like that each and every month, but generally speaking, over time, these seasonality patterns hold, and it's one thing that inputs and feeds our risk barometer. It's not a primary, but it is kind of a backup and tiebreaker because these seasonality patterns tend to hold and test through time. And so we're moving into a more positive part of the seasonality, which is another sign, and it's good to see the breadth improving in the market. So hopefully that holds. So those are three good things. Last, we're going to talk about inflation contributions. So much of the talk, and if you're with it thirdly, we certainly spend some time unpacking in great, excruciating, some might say, detail, inflation contributions. But I like this aspect of it because we've got readings in the 4 or 5% range, but this breaks it down to show you exactly what the contributions are. And the first thing I'll show you is the blue at the bottom. The blue is that housing. Sneak preview, if you haven't caught the thirdly yet, that is one of the things that shall underpin inflationary dynamics in the coming 6, 12, 18 months is a strong reading from housing inflation. There's just no way around it. The high housing prices, unless something changes there, which wouldn't be good, that's going to feed through these inflationary readings. Above and beyond that are the variabilities, particularly transportation, which is adding a lot. You could see almost 3 percentage points due solely to transportation. That's going to be due to high used car prices, which have been stubbornly high, as well as crude oil, which is continuing to boom and go on up. And of course, we've seen that pain spread across our oceans, both into Asia and Europe, in a more painful scenario. So, in some ways, we're lucky to have that impact. But that's a widely variable contribution. It may stay there a while. It may come back down. We shouldn't be too confident either way in that prediction. But that holds a lot of keys for where this ultimately goes. So thanks again for giving us a few minutes of your time. Feel free to give us a call and schedule your complimentary meeting today. You can phone call 800-928-4001 or scan this QR code. It'll take you right to our link to schedule. And lastly, don't forget there's a chance to catch our radio show program either live on the air or through a more convenient podcast format. Thanks again and have a great weekend.